Hey guys, this is your accounts teacher ARD, and the topic of the day is single entry, also known as incomplete records. Now, what a single entry means? Single entry means that we need to make accounts, but we do not have proper double entry records available. Now, why is that so? Why we do not have double entry records? There may be two reasons for that. The first reason is that we are a small business, we are a small shop maybe, and we cannot afford a full-time or professional accountant due to resources or finance issue. So therefore, we are trying to make or maintain accounts ourselves because we are not familiar with the accounting terms and the accounting basically. So therefore, we do not have updated records, because we do not have a proper accountant to maintain such records. And the second reason is that we had an accountant who is currently working, but due to some reason the accounts are being destroyed. Why are the accounts being destroyed? Maybe there is a fire in our office, maybe the accounting records were destroyed due to fire, or maybe there is some flood who has affected our business premises, our accounts office, or there can be some other natural calamity or disaster. So these are basically two reasons to maintain accounts using single entry. If there was the latter case that we do not have an accountant, so what we need to do, we need to just hire an accountant at the end of the year for maybe few days or few weeks and pay him some money, and so that the accountant can prepare accounts for us using single entry concepts. So this is known as a single entry. Now let's move forward. There are some terms that we need to understand. First of all, there is a term known as statement of affairs. Statement of affairs, these are not the affairs that most of the guys are thinking about. These are something different. Statement of affairs means it is a rough balance sheet. Balance sheet is also known as statement of financial position. Now, what is the primary difference between statement of affairs and balance sheet? Balance sheet basically contain all the categories such as non-current assets, then current assets, then the three column for non-current assets. One was cost, then was accumulated depreciation, then we have net book values. Then we have capital, then and the last we have liabilities, non-current liabilities and current liabilities. So basically balance sheet is categorized in different categories, and there is a proper format for statement of financial position. But as a statement of affairs is concerned, there is no proper headings for non-current and current, and there is no classification for non-current liabilities or current liabilities. What we need to do, we just need to list all the assets, then we need to deduct all the liabilities, then assets minus liability is equal to capital, or also known as net assets. So this is basically statement of affairs. Statement of affairs is basically a statement to calculate capital. Assets minus liability is equal to capital, or net assets is known as statement of affairs. One more difference between a statement of financial position and statement of affairs is that in a statement of financial position, if you remember, we make a statement of financial position. There is a proper format in capital section, which was known as financed by previously. It was opening capital, add profit for the year, less drawings. It was opening capital, add profit, less drawing, and then we get closing capital. In statement of affairs, we do not have profit. Therefore, we cannot calculate, we cannot make a reconciliation statement for profit such as opening capital, then add profit for the year, or less loss for the year, less drawing. So therefore, we need to just make assets minus liability is equal to capital. So statement of affairs is basically a statement just to calculate capital. So opening statement of affairs means opening capital, and closing statement of affairs means we need to calculate closing capital. Opening capital formula is opening assets minus opening liability, and then closing capital can be calculated as closing assets minus closing liability. So this was basically the format for statement of affairs. Then we have calculation of profit or loss. Sometimes we do not have records for sales or purchase or expenses. So therefore business is very easy going. So we are running business in a very casual format. We do not have proper records, but still at the end of the year we need something so as to ascertain the level of profit that the business has earned. So now if we do not have any records relating to sale, purchase or return inward, outward and income and expenses and other incomes, now we have basically a very easy way to calculate profit and loss, which is practically used in many small businesses. Now what is the format? As you are already aware, when making a balance sheet you need to make this working known as finance by previously, which was opening capital, add profit or less loss for the year. Then we add additional investment. You must have, I guess you haven't seen this before, but this always comes here. If we add or inject additional capital into the business during the year, we need to add it here. And then less drawing, we get closing capital. So I'm sure all of you have made statement of financial position before. So this is the capital part of a statement of financial position in a sole trader, and in manufacturing also this is a format that we follow. So what we need to do in a single entry scenario, if we do not have any records of sale, purchase, income and expense, what we need to do, we just need to see the opening capital. We must have an opening capital. Why? Because when we started business, or if we haven't started business this year, at least at the start of the year we need to calculate the capital. So how is capital calculated? Again, opening assets minus opening liability is equal to opening capital, and then closing assets minus closing liability is equal to closing capital. We have opening capital, we have closing capital, we do not have profit or loss. This is the unknown figure we need to calculate. Then we already have the amount of money that we have invested in the business during the year. This is additional investment. Then we must have known the drawings for the year. Drawing means as you are aware, the owner have taken out cash or check or goods from the business for own use or personal use or for the use in home. So this is known as drawing. So what we originally do, we start up with opening capital, add profit and less the loss, and add additional investment, then deduct drawings, we get closing capital. Now what we need to do, we need to do reverse working. We'll be starting with closing capital, and then as you are aware, the drawing is normally deducted. We will now add back the drawing because we are doing reverse working. Then if we add additional investment, we will be deducting this additional investment. We do not have the profit or loss figure. This is the working that we are doing in order to ascertain the value of profit and loss. And then we'll be deducting opening capital. Why? Because opening capital is normally added, we'll be deducting. So we'll be doing reverse working. We'll starting with closing capital, add back drawing, then less additional investment and opening capital. What we will get is the figure for profit or loss. Now this is very intuitive or very understandable thing. We can also discuss the concept or underlying idea behind that. If for example at the end of the year I have closing capital of maybe 100,000. If I have withdrawn 25,000 during the year, why am I adding up the drawing? Let's say for instance we have not done drawing this year. So if I haven't drawn out any money from the business, will be my closing capital greater at the end of the year or lesser? It will be greater at the end of the year if I had not drawn money out of the business. Therefore, I am adding up this drawing. So 100,000 plus 25, this means the capital was actually 125,000 if I haven't made any drawings out of the business. Then additional investment, for example, I have invested 50,000 during the year. So therefore this 50,000 is not my profit. So I'll be deducting 50,000 from this figure. This was 125. So 125 minus 50 will remain 75, I guess. 125 minus 50, this is 75. Then for example, at the start of the year, I only have capital of 5,000. I started business with only 5,000 capital. Now I have the capital right now 70,000, but at the start of the year, the capital was only 5,000. So you can see the difference is 70,000. This means my capital has been increased by 70,000 during the year. So therefore, the capital that has been increased during the year is known as our profit for the year. And if this figure is negative, this means it is the loss for the year. Okay, so I hope you understand a basic way of calculating profit or loss. If no records of sale, purchase, income or expense are given, we can use the reconciliation statement that we have already learned using statement of financial position while making statement of financial position. Then we have another thing, then the most common type of question that come in single entry or incomplete records during the examinations, whether it's O levels or whether it's AS level, we need to make a proper income statement, just like we need to make a proper income statement for a sole trader. But the difference again here is that we do not have sales and purchase given in the question. We do not have proper double entry records as we used to have when we need to make account using a proper trial balance. We do not have a trial balance right now. Why do we do not have a trial balance? Because we do not have proper T accounts for all our account balances. If we do not have T accounts, we cannot balance them. If we cannot balance them, we cannot get trial balance. If there is no trial balance, there is no easy way to prepare income statement and statement of financial position. If there is no easy way, so there should be some way as to make accounts for the year. Now, rather than making this simple statement, most of the times business make a proper income statement so as to calculate profit and loss, which is actually a more accurate way of depicting profit or loss for the year. Now, how can we do that? We need to calculate sales first of all, because sales in most of the time in a single entry question is not given. So let me remind you what sales do actually come in an income statement, whether it is a credit sale or a cash sale or a total sale. So answer is a total sale, and total sales mean cash sale plus credit sale. So cash sale must be given in an examination question. Cash sale is normally shown in an examination CIE question with the name of cash takings or takings banked, TAKINGS. So takings is basically cash sale. Sometimes it's said takings banked, means the amount of cash sale that has already been deposited in the bank. So cash sale or cash takings is the same thing. Then we add credit sales. So cash sales is basically given in the question, and the credit sale is not given. We need to find out the credit sale. And how can we actually find out the credit sale? We need to make a control account for sales ledger control account. Now sales ledger control account is an account for debtors. It is not an account for one debtor or one customer. It is an account for all the customers altogether. As you may have learned from your earlier studies, my earlier lectures, that a sales ledger control account is found in a general ledger. There are basically three ledgers: sales ledger, purchase ledger, and general ledger. Sales ledger contain individual accounts of debtors, purchase ledger contain individual account of creditors, and general ledger contains all the combined account, whether for sales, purchase, return inward, return outward, as well as sale ledger control account and purchase ledger control account. So we are making sale ledger control account. You have already studied sale ledger control account previously while we were studying the topic of control account. If you haven't gone through the topic of control accounts, I will strongly recommend to first go through the topic for control accounts while moving to this single entry. So we'll be using control accounts in a single entry, starting off with balance BD. Balance BD is an opening balance for debtor. As you may be aware that debtor is an asset for the business, then for opening assets will come on debit side. If opening assets are on debit side, closing debtors will always come on the credit side. This is opposite side. In a single entry question, the minority balances or abnormal balances for SLCA or PLCA are not normally need to calculate it. So in a single entry question, there is something easy, and we do not need to worry about the minority balances either for SLCA nor for PLCA. So we'll just be writing the normal balance. Normal balance for SLCA is debit because it is an asset for the business. So balance CD will come on the opposite side. Therefore, then we need to calculate sales. Sales is not normally given in a single entry question. So we need to calculate the sale. This is an unknown figure. This is an X figure we need to calculate. Then as you're aware, if a customer pays the money, the debtor will be decreased. We'll be making an entry cash or bank debit, and debtors will be credited. So if the examination question does not mention whether we have received money through cash or bank, we'll be always be writing bank, because the business normally prefer dealing with bank. Then we have discount allowed. If the customers are paying us earlier than promised, we'll be giving them discounts, and these discounts will be reducing our debtors. Then we have bad debt, also known as irrecoverable debts. If the customers are unable to pay us the money they owe to us, and they are known as a bad debt. Bad debt normally decreases debtors bad debt debit or debtors account credit. Then we have return inwards, also known as sale return. Return inward will be debited and debtor account will be credited. So we need to calculate this. The greater side will be credit because there is one thing missing on the debit side. So we need to write the total figure on the both the sides. Then from this total figure we need to minus this balance BD in order to get a figure for sales. Again, this sales is always credit sale because SLCA is a debtor account and debtor account does never include cash sale. This is only a credit sales. So therefore, if we add cash sale in this credit sale, we'll get total sale. Credit sales will be finding with this SLCA and cash sale will always be given in the question. And if it is not given, we'll be assuming all the sales are on credit. So therefore, the credit sale becomes the total sale that will be included in an income statement. Then after SLCA will be making PLCA. Again in income statement or profit and loss account we use total purchases. So therefore cash purchase plus credit purchase is equal to total purchase. So cash purchase is basically sometimes given and most of the time cash purchase is missing in the question. Why? Because businesses normally purchase on credit and they do not buy goods on cash. So if a business also buys goods on cash, it must be written in the question. So we need to add both of these in order to get total purchase for income statement. So how we need to calculate credit purchase? We need to make a PLCA. Purchase ledger control account is an account basically for creditors. So creditors is a liability. Opening liability come on balance BD will comes on credit side. If balance BD is on credit side, balance CD will always be coming on the debit side, opposite side. So in PLCA question or especially in single entry scenario, there are no minority balances, minority or abnormal balances. If you need to find out what does abnormal or minority balances mean, you should check out my lecture for control accounts. Then whenever we pay our suppliers, will be actually deducting or reducing a liability, will be debiting PLCA, that is liability account, debiting PLCA and crediting bank or cash. Similarly, if it's not mentioned that we have paid suppliers through cash or by check, we'll always be writing bank. Then discount received, if we pay our supplier earlier than promised, then we'll be receiving discount from our supplier, which is basically an income for us. The entry will be PLCA liability debit and discount received income account credit. Then return outwards, also known as purchase return. If we return goods to our suppliers due to some reason because they are faulty or does not suit our requirements, we'll be debiting PLCA, will be reducing our liability and crediting return outward account. Then balance CD, again the greater side will be debit side because there is one thing missing on the credit side, that is purchase. So we'll be writing the greater side on both the sides, then deducting balance BD from this figure in order to get purchase. Then this purchase is always credit purchase because a PLCA does never include a cash purchase. Because PLCA is a liability account and liability is always created when we are making a liability is always created when we buy goods on credit. Liability is never created when we buy goods on cash basis. So I hope you understood how to make an SLCA in order to get credit sale and how to make a PLCA purchase ledger control account in order to get a credit purchase. Then we need to add cash purchase and cash sale in order to get total sale and total purchase figures. Then in single entry there can be something else. Maybe there is some sort of expense or any other item missing. So for that we need to make a cash account or a bank account respectively. Now what I have done, I have made a cash book with two columns, one for cash and one for bank. You can make a T account individually on need basis. If there is something missing in cash, we need to make a cash account, and if there is something missing in a bank, we need to make a bank account. And if both the things are missing, you can make a cash book also like this given in the format. Starting with balance BD, as you are aware, cash is always an asset, so balance BD is always debited. Bank can be balance BD debit because we have money in the bank, or bank balance can be credit as well because it is an overdraft. See, if the balance BD for cash or bank is on debit side, balance CD can come on credit side. Cash always comes on the opposite side. But bank balance, if opening balance is an overdraft, it is coming on credit side. Then if the closing balance is always is also an overdraft, it will be coming on opposite side. So basically cash is always an asset. So opening balance is always on debit and closing balance is always on credit. But the bank Opening balance can be debit or credit. And again, similarly, closing balance can be debit or credit. So it can be a scenario that we are starting off with a bank balance, but ending up with an overdraft at the end of the year, ending up with an overdraft. And it can also be there that we are starting up with an overdraft, but at the end of the year, the balance CD is a normal balance, that is, it is a bank balance. So it can be one balance, it cannot be two balances at once. In a bank, there should be a bank balance, that is a positive balance, or it can be an overdraft. It cannot be both balances at the same time in an examination question. Whenever we are receiving money from any source, we'll be writing it on debit side. Means if we are selling goods on cash, the cash will be debited. If we are receiving money from our debtors, if there is a cash coming from debtors, cash will be debited. If there are checks coming from debtor, bank will be debited. So in my scenario, what I have done, I need to calculate this receipt from debtors in terms of cash. Means my debtors have paid me some money, but I do not remember exactly how much money has been received from debtors. So I am writing this as a question mark. So this is an unknown figure that needs to be calculated. Then if I sold some non-current asset, I'll be debiting my cash or bank respectively. Similarly, if owner has invested money into the business, then again cash or bank will be debited. Also, there can be other debits. Maybe if I have borrowed loan from bank, so bank will be debited. Then on the credit side, if I have drawn money out of the business in terms of cash or bank, so cash or bank will be credited respectively. Then if I have paid money to my creditors, that is suppliers, then cash or bank will be credited. Then if I have paid some sort of expenses, or maybe I have purchased some non-current asset through cash or check, so therefore it will come on the credit side. And if all of the things are given, can we calculate anything that is missing? Yes, exactly. See, in a cash account, one thing is missing, that is received from debtors. Then if we balance the credit side of the cash account will be greater. Why? Because there is one thing missing on the debit side. So what we need to do, we need to make this figure right on both the sides, that the greater side will come on the both the side. Then we'll be deducting all this in order to get this unknown figure. Similar things can be done with a bank account. There can be one thing missing in the bank, maybe the drawing from bank is missing. So what we need to do, we need to calculate the greater side. If the greater side is debit, it will be written on the both the sides, and then we'll be deducting all this in order to get the drawing figure. So see, we can use simple cash or bank account in order to find missing figures. Then in the last, we have some other concepts relating to single entry. It is markup versus margin. Markup versus margin has already been covered in a ratios analysis topic. If you are unsure about what does profit markup and margin means, you may see my video lecture for ratios analysis in order to understand the difference between profit markup percentage and profit margin percentage, and how can we convert from markup to margin, and how can we convert from margin to markup. You may see this, you may study this from ratios analysis topic. Then we have depreciation. In single entry, sometimes or most of the times, the examination question does not mention the depreciation method, nor the examiner mentions the life of the asset, or the examiner also does not mention the percentage or rate of depreciation or method of depreciation. If any such information is not given, then it is not possible for us to calculate depreciation using straight line or a reducing balance method. Now what we need to do, we need to calculate depreciation using a revaluation method. Now revaluation method, as you may be aware if you have already studied the topic depreciation. If you haven't, again, these are all the concepts that will come along the way. So you must go through that depreciation concepts right away. So in a depreciation, if we need to calculate using revaluation method, there is very simple formula. There can be two methods. The easy formula is that we need to start up with opening value. Opening value of what? Opening value of non-current asset. Opening value or net book value will be given in the examination question. See, if two values are given, the cost of an asset at start of the year and value of that asset or net book value at the start of the year, we will consider value and not the cost, because it is a revaluation method, and in valuation method we always see the value. So basically this value opening value is the closing value that we had in the previous year. Now, how can we get the closing value? Actually, we use some valuer or an appraiser firm or a person so as to understand, so as to estimate and to get an opinion as to what value our non-current asset had at the end of the year. So this is the opening value at start of the year. We'll be adding addition. Addition means we have bought new non-current asset, so the cost of that asset will be added here. Then minus disposal, if you have sold any assets during the year, we'll be deducting that as a disposal. See, again, there are two things. If I have sold a non-current asset for 1000 which had a value of 1500, I'll be writing 1500 here and not the amount that I've actually received from disposal. So basically in this disposal, this is the value of the asset that is sold and not the amount that we have received. Thirdly, if there are three items given, the cost of the asset that has been sold is also given, the value has also been given, and the amount that we have received is also given. Again, we will be considering value and not the cost and not the amount that we have received. Okay, so there will be the value, and then again the closing value. Again, the closing value will be estimated either by the manager himself or the owner himself, or maybe a professional valuation firm can be hired in order to get the value of this. So this is the closing value. So this is the shortcut formula for calculating depreciation using revaluation method. It can also be solved using a T account. So I recommend making a T account only when an examination question specifically asks for it. If the examination question does not particularly ask for a T account, for a net book value account, we can only calculate depreciation using this simple equation or formula. So again, you can also see this if the examiner specifically asks for it. Starting with balance BD, that its opening balance, will be adding up all the assets. Again, this is bank or payable addition. If you have sold the asset, we'll be transferring it to disposal. Again, we will be using the value and not the amount that actually have been received. Then the closing value of balance BD is on debit side, balance CD comes on the credit side. Then the difference is income statement. This is current income statement. This is a current year depreciation. Okay, so I hope guys you understood all the concepts underlying single entry, and if you did and if you benefit from this video, kindly do share this video with other fellow accounting students, and if you haven't subscribed my channel, you must do it right now. Thank you.